Richard retired at 62 after more than 3 decades of steady work. He had done everything right. He saved consistently, avoided unnecessary risks, and entered retirement with a solid plan. Like many retirees, he wanted to take advantage of the years before Medicare to make smart financial moves. His income was lower than it had been in decades, his tax bracket was favourable, and every article he read told him the same thing. This was the perfect time to take control of his retirement accounts and reduce future taxes. So he did exactly that. Over the next year, he began moving money out of his traditional retirement account and into a Roth, carefully converting amounts that made sense based on his current tax situation. He paid the taxes up front, believing he was setting himself up for a more stable and predictable financial future. His advisor agreed with the strategy. Everything looked right on paper. Nothing seemed out of place. Then, 2 years later, something changed. When he enrolled in Medicare at 65, he expected the standard monthly premium that most retirees pay. But instead, the letter he received showed a number he wasn't prepared for. His premium was significantly higher, not because of anything he had done recently, not because his current income had increased, but because of a decision he made years earlier, at age 63. That's the part no one warned him about. Because what most retirees don't realise is that the IRS and Medicare don't treat every age the same. Age 63 is different. It's the point where your financial decisions stop being just about taxes today and start determining what you will pay for healthcare in the future. And by the time most people understand this, it's already too late to change it. Right now there are thousands of retirees making decisions at 63 that seem smart in the moment, but quietly trigger higher costs later. No alerts, no reminders, just a system that assumes you already know how it works. And that's exactly why this matters today. Because once you understand what really happens at age 63, you don't just avoid a mistake. You take back control of decisions that could impact your retirement for years to come. Because once you understand what really happens at age 63, you don't just avoid a mistake, you start seeing how every financial decision connects to something bigger that most people never notice. And the truth is, this isn't about one rule or one system. It's about how different systems quietly overlap at the exact moment when retirees believe they finally have control. At first, it doesn't seem complicated. You retire, your income drops, and naturally, you begin thinking about how to use those lower income years to your advantage. Maybe you consider moving money from a traditional retirement account into a Roth. Maybe you decide to sell an investment that has grown over time. Maybe you take out a little extra to cover a major expense. All of these decisions feel logical, even responsible. And from a tax perspective, they often are. But what most people don't realise is that at age 63, the impact of those decisions doesn't stay in the present. It moves forward. It gets recorded. And 2 years later, it comes back in a way that feels completely disconnected from the original decision. That's because Medicare doesn't calculate your costs based on what you earn today. It uses something called a 2-year lookback. This means the amount you pay for your Medicare premiums at 65 is based entirely on your income at 63. Not what you're earning when you enroll. Not what your situation looks like now. But what your tax return showed 2 years earlier. And that's where the disconnect happens. Because when you're 63, you're not thinking about Medicare premiums yet. You're thinking about taxes. You're thinking about reducing future required distributions. You're thinking about long-term savings. You're making decisions based on the information that feels relevant at the time. And nowhere in that moment does it feel like you're setting the price for your healthcare 2 years into the future. But you are. And the way that price is calculated is not gradual. It doesn't slowly increase as your income goes up. It works in tiers, almost like steps on a ladder. As long as your income stays below a certain level, you pay the standard premium. But the moment you cross that threshold, even by a small amount, your premium jumps to the next level for the entire year. It's not a smooth curve. It's a sudden shift. So imagine this for a moment. You make a financial decision at 63 that increases your income just enough to cross that line. Maybe it's a Roth conversion. Maybe it's a stock sale. Maybe it's a one-time withdrawal. At the time, it doesn't feel like a big deal. You've planned for the taxes, you've done the math, and everything checks out. But 2 years later, when you enroll in Medicare, that one decision shows up in a completely different way. Your premium is higher. Not slightly higher, but noticeably higher. And not just for 1 month, but for the entire year. And if you're married, that increase applies to both of you. That's when the realization hits. It's not that you made a bad decision. It's that you made the right decision at the wrong time. And this is exactly where most retirees feel blindsided. Because nothing in the moment felt risky, nothing felt like it would come back later. And yet, that's exactly what happens. Now here's where things become even more complex, because at age 63, you're not just dealing with Medicare. You're also navigating other systems that are reacting to your income in completely different ways. And this is where the real challenge begins. On one side, you have the tax system encouraging you to take advantage of low-income years. This is often called the gap period, the time between retirement and when required distributions or full benefits begin. During this period, your income may be lower than it has been in decades, which creates an opportunity to move money, realize gains, or restructure your accounts in a tax-efficient way. From a purely tax perspective, it makes perfect sense to generate income during this time. But at the exact same moment, another system is pushing in the opposite direction. If you're not yet on Medicare and you're relying on private health coverage, your insurance costs may depend heavily on your income. Lower income can mean lower premiums or even subsidies that significantly reduce what you pay each month. But as your income rises, those benefits shrink or disappear entirely. So now you're caught between two competing forces. One system is telling you to increase your income while your tax rate is low. Another system is rewarding you for keeping your income as low as possible. And then quietly in the background, Medicare is watching your income at 63 to determine what you will pay later at 65. 3 different systems, 3 different rules, 3 different outcomes, and none of them line up perfectly. This is why 2 people can follow the same general advice and end up in completely different situations. One person spreads their income over several years, staying below key thresholds and avoiding any major impact. Another person concentrates their income in a single year, crosses a line they didn't even know existed, and ends up paying significantly more in the future. The difference is not intelligence, it's timing. And timing is everything at this stage of retirement. Now let's bring this down to a more personal level, because this is where it really starts to matter. Imagine a retiree who decides to convert a large portion of their retirement account at age 63. They've done the research. They understand the long-term benefits. They want to reduce future taxes and simplify their financial picture. So they move forward with the plan. They convert a significant amount, pay the taxes, and feel confident that they've made a smart decision. And in many ways they have. But what they didn't account for is how that income would be viewed 2 years later. When they reach 65 and enroll in Medicare, their premium is no longer based on their current situation. It's based on that higher income year at 63. And suddenly the cost of healthcare is higher than expected, not because of anything they're doing now, but because of something they already did. And here's the hardest part. There's no way to go back and change it. Once that income is reported, once that tax return is filed, it becomes part of the system. It's locked in. And when Medicare uses it to calculate your premium, it does so automatically. There's no warning, no adjustment, and no second chance just because you didn't know. That's why understanding this before you reach 63 is so critical. Because once you know how these rules work, you gain the ability to control them. You can spread income across multiple years instead of concentrating it in one. You can stay below key thresholds. You can plan decisions with both tax impact and future costs in mind, instead of focusing on just one side of the equation. And that shift in perspective is what separates retirees who stay ahead of the system from those who spend years reacting to it. Because at the end of the day, this isn't about avoiding every cost. It's about avoiding the costs you didn't expect. The ones that don't show up until later. The ones that feel disconnected from the decisions that cause them. And age 63 is where those hidden connections begin to matter the most. And once you begin to see those hidden connections, the next step is understanding how they actually play out in real-life situations, because this is where everything becomes clear. It's one thing to hear about rules and thresholds, but it's another to see how a single decision can quietly shift your financial outcome years later. Take someone like David, for example. He retired in his early 60s with a solid savings base and a clear plan. His income dropped significantly after leaving his job, and like many retirees in that position, he saw an opportunity. His tax bracket was low, his expenses were manageable, and he wanted to take advantage of that window before future income started rising again. So he decided to move a portion of his traditional retirement savings into a Roth account. It felt like a smart, forward-thinking decision, and in many ways, it was. He completed a large conversion in a single year, paid the taxes from separate savings, and felt confident that he had reduced his future tax burden. From a long-term perspective, everything looked exactly as it should. But what he didn't realize at the time was that the size and timing of that conversion would be recorded as income at age 63, and that number would later be used to determine his Medicare costs. 2 years later, when he enrolled, the impact showed up. His premium wasn't what he expected. It was higher, not because of what he was doing at that moment, but because of what had already happened. And that increase didn't last for just a month or two. It stayed with him for the entire year, quietly reducing the benefit he thought he had secured. Now consider a different situation. Imagine a couple, both around the same age, managing their finances together. They're not doing anything unusual. One of them works part-time, bringing in some extra income. They decide to sell an investment that has grown over the years, something they've been planning to do anyway. They also take a small withdrawal from their retirement account to handle an expense that came up unexpectedly. Each of these decisions makes sense on its own. None of them feels like a major financial move. But when combined, those decisions push their total income above a certain threshold. And because it happens at age 63, it sets a chain reaction in motion. 2 years later, when they both enroll in Medicare, they're no longer paying the standard premium. They've moved into a higher tier, and the difference is noticeable. Over the course of the year, that extra cost adds up in a way they never anticipated. And this is what makes the situation so frustrating for many retirees. They weren't being careless. They weren't making risky decisions. They were simply living their lives, making reasonable choices based on the information they had at the time. The missing piece wasn't discipline, it was awareness. On the other hand, there are retirees who go through this same phase without any issues at all. Their income remains below the critical levels, either because they don't have large retirement accounts or because their financial activity is more limited. For them, age 63 passes without any noticeable impact on their future costs. And this is why the rule often goes unnoticed. It doesn't affect everyone equally, but if you have flexibility in how and when you generate income, then this is something that applies directly to you. And that's where the real opportunity lies, because once you understand how this works, you don't have to avoid these financial strategies altogether. You don't have to give up on Roth conversions or delay every decision indefinitely. What you need to do is adjust the timing and the structure so that you stay in control of the outcome. Instead of making one large move in a single year, you can spread it across multiple years. Instead of crossing a threshold by accident, you can stay just below it with careful planning. Instead of reacting to higher costs later, you can prevent them before they ever appear. This is where small adjustments create meaningful differences. And this is also where many retirees begin to feel more confident because they realize the system isn't working against them. It's simply responding to the information it's given. Once you understand the rules, you can work within them instead of being surprised by them. Now there's another layer to this that becomes even more important as you move further into retirement. And that's what happens when circumstances change over time. Income levels shift, accounts grow or shrink, and life events occur that you can't always predict. The decisions you make at 63 don't exist in isolation. They become part of a timeline that continues to evolve. For example, imagine a situation where one spouse passes away later in retirement. The surviving spouse now files taxes as a single individual instead of jointly. The income thresholds that once applied to both of them together are now cut in half. The exact same level of income that didn't trigger higher costs before can suddenly push the surviving spouse into a higher bracket. And this is where earlier planning can make a significant difference. If some of those taxable assets had been converted or repositioned earlier, the surviving spouse would have more flexibility. They could rely on income sources that don't increase their taxable income, helping them stay below those new thresholds. But if everything remains in accounts that generate taxable income, the options become more limited. This is not something most people think about in their early 60s. And yet the decisions made during that period can shape the financial experience years later in ways that are difficult to reverse. That's why awareness at this stage is so valuable. Because it allows you to think ahead, not just for the next year or two, but for the long-term structure of your retirement. And this brings us to the most important part of this entire discussion, which is what you should actually do based on where you are right now. If you're still in your early 60s and you haven't reached 63 yet, this is your opportunity to plan ahead. You have time to organise your income, evaluate your options, and make decisions in a way that avoids unnecessary costs later. This is where proactive thinking has the greatest impact. If you're already 63, then every decision you make for the rest of the year carries more weight than it might seem. This is not the time to guess or assume. It's the time to be deliberate. Look at your current income, understand where it stands in relation to key thresholds, and make sure any additional income you generate is aligned with a clear plan. If you're past this stage and already on Medicare, then the focus shifts slightly. Now it becomes about managing your income in a way that keeps future costs stable. Because the look-back rule doesn't stop. It continues throughout retirement, meaning today's decisions still shape tomorrow's costs. And in some cases, if your situation has changed significantly, there may be ways to request adjustments based on new circumstances. But those opportunities depend on specific conditions, and they are not guaranteed. The most important takeaway from all of this is simple. This isn't about avoiding financial strategies. It's about understanding when to use them. Because at age 63, timing becomes just as important as the decision itself. And for many retirees, that one shift in awareness is what turns a confusing system into something they can finally control. So as you move forward, take a moment to look at where you are today, not just in terms of your age, but in terms of your financial decisions and how they connect to the years ahead. Because the more clearly you see that connection, the more confident you become in the choices you make. And in retirement, that confidence is just as valuable as the money you're working to protect. Now, before you leave, I want you to take a moment and think about where you are right now in your own retirement journey. Whether you're 60, 62, 63, or already past 65, the decisions you make today are shaping what your future will look like in ways most people never realize until it's too late. And the truth is, just understanding this one rule about age 63 already puts you ahead of thousands of other retirees who are still making these decisions blindly. If this video helped you see something you hadn't noticed before, don't just move on. Take a second and hit the like button, because that tells YouTube to show this information to more people who genuinely need it. And if you're not subscribed yet, make sure you subscribe right now and turn on notifications, because every week we break down the exact rules, hidden traps, and strategies that can help you protect your money and avoid costly mistakes in retirement. Also, I want to hear from you. Did you already know about the age 63 rule, or is this the first time you're hearing it? Let me know in the comments below, because your situation might help someone else avoid the same mistake.